Boy, the global economy in 2025 is a roller coaster, both in terms of data and emotions. If nothing else, it showed more resiliency than economists had predicted. For the global economy, this was the year of tariffs. Global trade and growth were pretty much as expected in the first quarter of the year. Then came Liberation Day.
My fellow Americans, this is Liberation Day. Waiting for a long time. April 2nd, 2025 will forever be remembered as the day American industry was reborn, the day America's destiny was reclaimed, and the day that we began to make America wealthy again.
Sweeping U.S. tariffs on all its major trading partners, including neighbors, Canada and Mexico. China too, but even minor economic players such as the small African country of Lesotho. Markets panicked, shipping slowed, growth forecasts for the U.S. were slashed. President Trump backtracked on most but not all of the tariffs. There was a global sigh of relief, especially from U.S. allies and trading partners from Brussels to Tokyo.
A 15% all-inclusive tariff cap for the European Union. This is the most favorable trade deal the U.S. has extended to any partner. A wide range of sectors, including strategic industries such as cars, pharmaceuticals, semiconductors, and lumber, will benefit from this cap.
With China, the potential impact was perhaps the most pronounced, after the U.S. threatened to slap 100% tariffs on most imports from China. Trade talks led to a détente and potentially a longer-term deal in 2026. In spite of trade restrictions and other economic headwinds, China's economy grew an estimated 2.5 to 3% for the year. Its trade surplus topped $1 trillion for the first time. The World Bank predicted at the beginning of 2025 that the global economy would grow at 2.7%. That was revised slightly down to 2.3% in May due to trade tensions. Now, forecasts are back to roughly the same level as last January. The question is, have things settled down, or will 2026 be another wild ride? Okay, it's time to bring in our panel here in the studio. John Tamny is president of Parkview Institute and editor of Real Clear Markets from Portland in Oregon. Liang is chair professor in economics at Willamette University. Andy Mock is senior research fellow at the Center for China and Globalization. He's joining us from Beijing. And from Sao Paulo, Gilson Schwartz is professor of economics at the University of Sao Paulo. And John, why don't I start with you? You're here in the studio. The economy looked pretty good in the third quarter, a big jump in the GDP, about 4.5% almost. But one economist says it's an odd time because the numbers say one thing, but people are feeling something different. Is that an accurate way to look at it, and why is there that kind of imbalance, would you say?
Well, I think a more accurate way of looking at it is that what's good for the economy is invariably bad for GDP and vice versa. Let's look at why this number went up. Imports went down. In what rational look at any economy anywhere in the world is an economy improving if people are sending fewer goods and services to that country, if they're dividing up work less with that country? But in the infinite wisdom of economists who created this monument to double counting and fraudulent numbers, GDP actually goes up the fewer imports a country takes in, and conversely, GDP actually goes down if we are exporting more shares in the greatest companies on earth. It actually brings GDP down.
Another story in 2025 is AI, and people all on board, and we're hearing all of the dot-com bubble burst that we saw in the late 90s to 2000. People concerned that maybe the numbers are too high. What's your sense about AI and investments there?
Well, there's going to be lots of stumbles, as is always the case anytime something new is introduced to the economy. People will call them bubbles, and they will look unsophisticated saying that. What this is a growth spasm. It's a massive surge of investment into something that's going to transform how we work and live and make us better. Technology never puts us out of work. It just improves how we work, makes us exponentially more productive. To be young today, to be a baby today, knowing what's ahead, it staggers the mind.
Yeah, mind-boggling. Jan, we talked about the GDP numbers and being rather positive, and of course President Trump celebrated he said it's basically because of the success of the tariffs. I want to get your thoughts on that.
Well, I would say the U.S. economy grew well in the third quarter despite the tariffs. And let's not forget, I think that President Trump actually has already walked back a lot from the early April Liberation Day tariffs. I mean, most notably with China, now both countries entered a trade truce. And I think that brought a lot of prosperity and stability for both countries. And I think the question mark still for the United States economy is whether or not this will continue, because we know consumer spending has really contributed a lot to the third quarter GDP. Consumer spending has gone up by 3.5%, but right now we know by October, consumer spending has stalled. And also the consumer confidence, according to the conference board, has dropped to the lowest level in October since earlier in April this year. So there are a lot of question marks as to whether the consumers will continue to stretch their budgets and continue to spend. And the other question, of course, has to do with the AI. I think it's not, ironic that on the one hand, that AI will bring productivity growth, but that's going to over a longer time period. Whereas with all these AI fatigue, right, that we have heard a lot about, AI expenditure has really helped to fuel the economy so far. But whether or not that trend will continue, that still remains to be a question. On the other hand, I think China's economy is doing well, but it does show some growth slowdown in the most recent November data, which means I think China is probably going to reach the 5% growth target this year. But come next year, I think there's still uncertainty with regard to trade, also with regard to the real estate sector. So I think policymakers in both countries would need to remain vigilant and put forth policies that would help to stabilize the economy and help to continue with this growth momentum.
Andy, you're there in China. I want to talk to you a little bit about the Chinese economy, but let's take a step back and kind of review 2025 because Jan talked about the trade truce, but before the trade truce, there was all this kind of saber rattling and threats of 100% tariffs and all of that sort of thing. And yet, at the end of the year, you look at China, it's got a trade surplus of over $1 trillion, first time that's ever happened. Can you talk to us about how China navigated all of this, the turbulence out there?
That's absolutely right, Mike. I think that China's economy held up far better than many expected, especially in the United States. And that is despite, as you mentioned, there's still property weakness and an enormously complex geopolitical environment. But I think what this shows is a couple things. I think one, the resilience of the Chinese domestic economy, but also that there is almost insatiable global demand for affordable, high quality, and increasingly high tech Chinese products. So while exports to the U.S. went down, exports all around the world went up. So I think, again, the U.S., as we heard from our first guest, really is acting in an irrational way by restricting imports from other parts of the world, especially from China. And I think this is hopefully a artificial and temporary phenomenon because this only hurts consumers in the United States.
And Andy, what about economic growth? I mean, the IMF recently revised the country's annual growth forecast about 5%. As Jan pointed out, there are some headwinds out there for China, but where do you expect to see the Chinese economy going in 2026?
Mike, that's a question for me.
Yes. Yeah, Andy, go ahead.
Hello?
All right. Apparently, we've lost Andy. I'll get back to him in just a minute. Gilson, your country, Brazil, also kind of targeted by tariffs. President Trump upset about the charges against Jair Bolsonaro, using him kind of as a cudgel against Brazil. How's the Brazilian economy holding up, and what was the reaction there in the country to what was going on in terms of these trade tensions?
Well, again, we see the same phenomenon. Trump puts some threats, but at the end of the day, there's a truce, there's retreat, especially on the political arena, but also in terms of tariffs. So I think that I agree with our colleagues that there is more, I would say, more fanfare to what Trump announces as Liberation Day or as a new stage for American wealth. There's more fanfare than reality. And there are three very important, I would say, dark sides to the growth that is exposed right now. First one is the increase in public debt. Global public debt has been rising, and that's a problem when interest rates must go down, but they are also people talking about affordance. So the second issue here is that the growth is based more on the wealthy people, more on the upper classes, whereas the lower classes, lower income levels are still suffering. That's the second point. And the third point, we must not forget that AI is also putting a lot of pressure on natural resources. So I think that the key word here is sustainability. It's not a sustainable recovery or not a sustainable boost that can happen at any time. And there's a lot of uncertainty in terms of geopolitical issues.
We're about 11 minutes into this broadcast, John. I'm going to ask you this question because it seems like whenever you talk about economics here in the United States, years ago, you'd always have a deficit hawk on saying, deficits, deficit. You don't hear that in Washington anymore. But he's bringing up the point about debt. How much of a concern is that?
It's evidently not, and how we know it's not is that there's 38 trillion worth of debt, yet Treasury's borrowing costs are 4%. 45 years ago, we had 900 billion in debt, and Treasury's borrowing costs were 11%. This is not me defending the debt. Government spending is the central planning of precious resource to the economy's detriment. But the fact that we have 38 trillion in debt is the surest sign that it's not a problem. If it were a problem, no one would lend to us. And no one would lend to us because it's very expensive to lose money on loans. And so the fact that we have it is a signal from investors around the world that the U.S. economy's future isn't just bright, but it's blindingly bright.
Jan, let me ask you about the Nobel Prize-winning economist from MIT who said this after winning the award: "We're living through a singularly turbulent time." He said the developments of AI, rapidly aging populations, we see that in Japan and China, of course, climate change, and of course, tariffs. I imagine you probably agree with his sentiment that these are turbulent times. What is the turbulence doing out there in terms of how it's churning and affecting the economy?
Right. Well, we have been talking about this concept of polycrisis for a while now. So starting with the public health, but also, as you mentioned, geopolitical tensions, climate change, you name it. I think added to what has been spoken earlier is also this divergence, right? This disparity between the haves and the have-nots. The United States right now have really this K-shaped growth, where the top 10% account for over 50% of consumption. They are enjoying the stock market boom, whereas the lower income families are struggling with inflation and job stagnation and wage stagnation. So I think these are all the sort of difficulties, right? Economic challenges I think facing the world. Added to that, many of these armed conflicts, they're bringing famine, they're bringing many sufferings to people all over the world. So I think AI is definitely an opportunity, but at the same time, I think AI. A lot of times now we're seeing is that this becomes a big money scheme, right? We haven't really seen this AI translated into broad-based productivity growth, and yet we're really relying on capex spending on AI in order to fuel the economy and the stock market rally. So I think going forward, we really need to adopt policies, right, that are more pro growth, but also pro, income equality. And globally, I think really the kinds of collaboration is what we really need, right? These trade war, also sanctions, and also tech restrictions. None of this is conducive to economic stability and growth, let alone technological progress. Because I think for AI, both China and the United States are leading the AI development, and yet I think both countries are in some ways having this race, which I think to some degree is going to slow down and also compromise the adoption of AI broadly in the world. So I think all of these challenges need to be faced and needs to be fixed, and a collaboration is really the key to go. And talking about climate change, right now China is really leading the green transition in terms of renewable energy and also green tech. And I think that, again, takes a lot of corporations for China to be able to benefit the rest of the world and really accelerate the kinds of green transition that we really need in the current world.
And Andy, I think we got our signal back with you. China's been really pretty nimble when it comes to its economy and being able to adapt. So talk to me about what we're seeing there, because I think the IMF said recently that they think the annual growth forecast For this year, it'll be 5%. We've talked a little bit about some of the potential headwinds, but where do you see growth, and how is China shifting its approach moving into 2026, would you say?
Well, Mike, I think 2025, despite I think China's economy surprising many around the world, is really a transition year. And the driver here is artificial intelligence. And before I address that, I do want to say something about the U.S. Federal debt. I mean, it is not a problem until it is. And what we've seen is the dollar increasingly weak, and I think largely because of the monetization of the debt. Look at gold prices. And I think this is very, very important to point out in the context of China, because China has been an island of stability, not only from a trade perspective, but I think from a monetary perspective as well. And that lays part of the foundation for, I think, the outlook for 2026 and beyond. And I think artificial intelligence here will be an absolutely crucial driver. So if we look at the global economy, it's about, what, $130 trillion. And if you think even a 10% increase in productivity and value delivered by AI, I mean, we're looking at a $13 trillion opportunity per year. And what this means, though, is that China is uniquely positioned here. So not only does it have some of the leading frontier LLMs that are open source, which lowers the cost of adoption globally, but increasingly, as we move into this world of embodied artificial intelligence, or robots, where AI in the form of robots stop becoming some sort of tech product, but really capital goods that are deployed on factory floors, in your homes, et cetera. I think we're really poised to see an enormous positive secular uptrend with China at the center. The other point I want to make about this, too, is when we think about artificial intelligence, one of the real constraints is power generation. And China has about, I think, 10 terawatts of capacity of power generation compared to 4 terawatts in the United States. So it's more than twice that. And again, I think this shows that all of the major pieces are in place for a tremendous period of prosperity driven largely by artificial intelligence and centered in China.
And Andy, I was in China last year, and you go to these plants where they're churning out EVs, like boom, 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 and there's robotics all over the place. But I think people look at that and they say, wow, we're looking at the future. But then a lot of people look at it and say, well, wait, where are all the jobs going? And I think that's always a matter of concern. So what would you say to the people who are concerned that, as we see these advancements, that they're going to people are going to lose jobs as a result of it?
Well, Mike, I think any general purpose technology, whether we're looking at steam, whether we're looking at electricity, whether we're looking at computers, is tremendously disruptive. And it not only changes technology industry, but also has enormous societal and political ramifications as well. So I think the solution to this is not to say, okay, we shouldn't go down this path. I think in some sense, it's inevitable that technology is adopted, and it's just a question of speed and how do we balance the benefits with the cost. And absolutely, I think that disruption to traditional employment is certainly a huge challenge. And I think every government around the world is certainly focused on this.
Gilson, let me ask you kind of a similar question, because, Jan brought it up about this income inequality. As you look at the technological advances, clearly there are going to be winners and losers. What are some of the concerns as we move into 2026?
Well, that's another aspect of what Trump is doing. We see that several cuts in expenditures, public expenditures and funding for science and technology. So how can we move on? How can we make progress in such a challenging technological transformation if we cut funding to science and technology, if we just persecute intellectuals, as we have seen in the United States? So I think that the major challenge in terms of job generation is to foster educational transformation along with the AI challenge. And that's what's missing in the US. So Trump is doing a very irrational policy. I agree with Andy. Public debt is not a problem until it becomes a problem. So what we see is a changing pattern of public expenditure that penalizes education, science, and technology, whereas tariffs are seen as a major source of potential growth. that's not going to be sustainable. I think that AI, and you can see that in Brazil, is always a problem with education. It's always a problem if you have lots of innovation without employment, because the overall status of the workforce is low level, is low productivity. So I think that the public expenditure, if you have to forego public expenditure on science and technology and keep rolling over the public debt and favoring the upper classes, that's not sustainable. As I said, it's going to be boost. It's going to be a crash. AI crash, I think, is one of the major issues this year.
John, let me ask you about President Trump promising to take some of the tariff income and hand it back over to taxpayers, $2,000 checks he's talking about. Pentagon also promising bonuses for the military. And some people are saying, you know, this could drive up inflation. We saw a lot of stimulus during the COVID period. Is that a matter of concern? What's your thought on that?
Well, I think it shows a misunderstanding of what inflation is. Andy's right that inflation is a devaluation of the currency. And so the gold price is a concern. But I think Trump, like all presidents, got the dollar he wanted. He wants a weak dollar. He's incorrect about that. So the dollar is weakening because of that, not because of the debt. We've had debt for decades, and we've had a strong dollar during much of that time. Look at the yen in Japan. It soared amid rising debt there. So I don't think there's any association there. As far as Trump giving out checks based on tariffs, what a monumentally mistaken thing. The division of labor is the greatest driver of economic growth that the world has ever seen. It works in a factory, and it works even more when you're dividing up production around the world. And so to pretend that a $2,000 check could replace the genius of Americans working together with Chinese, with Japanese, with Indians around the world is just laughable, and it's not something fit for reasonable discussion.
And Jan, there's been this contention that the consumers are the ones paying the tariffs, not the countries. So if that's the case, are they really pocketing any cash?
Well, I think that's precisely the point. Even if Trump is able to overcome all those legal challenges, right? Let's not forget that this tariff may not actually continue, given the legal uncertainty about it. But even if Trump is able to send some checks, right, due to this revenues from tariff, let's not forget the tariffs are essentially consumption tax, right? It's a tax when the goods cross borders. And it's also a very regressive tax because usually it's the lower income that spend the most of their income in terms of share on consumption. And so the tax actually burden them more proportionally. So in other words, we're using this very regressive tax revenues and to send out checks to people equally. So that's just going to make the tax regime a lot more regressive than otherwise would be. And I also agree. I think tariff is a very interesting, tariff. It's a very interesting source of revenue in the sense that if you think tariff is going to help to protect the domestic industries, create jobs at home, ensure reshoring of manufacturing, et cetera, then you will want people to import less, right? But if people import less, that means you will have less import revenues, less tariff revenues. So you can't have these two at the same time. You can't have rising tariff revenues and yet claim that tariffs help to protect domestic industries and create jobs. These two cannot coexist. So I think, again, tariff is regressive, and tariff can be imposed in a very strategic, selective manner in a short period of time to try to carve out some room for domestic manufacturing revitalization or job creation. But right now, I think Trump's tariff has been unilateral, and it has been cross the board, and has been very unstrategic, unselective, and on and off. And all of these, I think, would suggest that tariff is really not used in a way that is effective, that would really achieve any of the goals that the Trump administration, would like the public to believe.
Gilson, I want to talk about another development that happened in 2025. The European Union delayed a vote on whether to approve a trade deal with Mercosur. And that was in the works for decades. What's your sense about that, and what about what we're seeing with trade between blocs and regions, and how is the Global South being impacted?
Well, I think that especially for Brazil, it's a really very, very pessimistic outlook. The agreement with the European Union was delayed, was postponed. It expected that maybe next year, but France and Italy are totally against that kind of agreement. There's a lot of issues here concerning not only the level of prices, but also the technological issues and also the quality, the health assurance with respect to some agricultural foodstuff in Brazilian production. So I think that there is a lot of issues that are unresolved. There is a strong opposition in France and Italy that makes it almost impossible to conclude that kind of agreement. So I think that we are pessimistic with respect to that. And I think that the forecast, we take, for example, the latest data published by the Economic Commission for Latin America and Caribbean, they're very pessimistic. There's a lot of mediocrity in terms of sources of growth and lots of concern with respect to the sustainability of our fiscal regime. So the European Union is acting on their own interest, and Brazil in particular is going to suffer a lot because there are no open horizons in terms of expanding exports or expanding trade.
Andy, let's talk about another bloc, BRICS. It's expanding. What do you see coming from it in 2026?
Well, Mike, I think certainly the center of gravity is moving away from North America, from the United States. I think, BRICS obviously has enormous growth potential. We look at the average age of the population. All of these macro level statistics is very, very positive. I do want to just change the topic a bit and mention something about the United States that was touched on earlier. I think there's 2026 is a congressional election year, and affordability is becoming an enormous issue in the United States. And we see Trump being very pragmatic. Look at the carve-out he just announced for importing Chinese semiconductors. And I think one thing that would make a lot of sense for the United States would be to allow the importation of Chinese vehicles. I mean, the average vehicle now in the United States is $50,000, and we can see, China offers vehicles at a fraction of that price. So it's good for the United States. To bring this back to BRICS as well. I mean, this is another, I think, very, very important growth area where China can provide high quality, cost competitive electric vehicles, batteries, the entire value chain. Right. I think this is a very, very valuable contribution for BRICS. And again, I think from the United States perspective, one note of optimism is that I think President Trump has been very, very pragmatic, and hopefully this will extend to addressing the affordability crisis that many Americans are facing.
All right. Well, we are going to have to leave it there. I want to thank all of you for joining us. Great discussion. And that's going to do it for this edition of The Heat. I'm Mike Walter in Washington, D.C.